NTPC is among the top Nifty gainers today. The company guides for strong capacity target addition and strong capex till FY32 post robust first quarter earnings. Brokerage is positive on the stock.
Colgate-Palmolive surge is reacting to a stellar set of quarterly numbers that were a beat across parameters. The company also witnessed continued demand pickup in rural markets.
Pfizer climbs nearly 3% after the company reported its quarterly numbers. The net profit climbed over 60% year-on-year as the margins expanded nearly 1,000 basis points.
Jindal saw zooms after reporting a good set of numbers in the past quarter. The revenues are up by close to 12% on a year-on-year basis. The profitability as well surges 70% year-on-year.
Idea Forge slips more than 10% after a poor quarterly performance. The company reported 11% decline in revenue from operations on a year-on-year basis, whereas the EBITDA saw a sharp contraction. The margins came down from 29% to 4%.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always, Mangala Malu. And as you see at the top of the screen, well, all the indices have moved into the green. This morning we started off in the red, but in fact that buy on dips does continue. The Nifty doing well, the Nifty Bank up close to around 200 points, and Mangalam, the breadth of the market as well. No worries whatsoever.
No worries whatsoever. And whatever the stocks which are moving today, they're backed by earnings.
Yeah.
Either way, the move on the way up or on the way down have earnings as their reason. And that's how market should be, right? So good going for the markets. We've seen a recovery from the lows and the broader markets doing well as well with earnings in focus. So let's talk about those earnings itself. Kalpataru products that clocked in a weakish first quarter performance as we had seen in the sector itself marred by higher heat waves and disruptions due to elections, etc. We have Amit Uplenchwar, who's the director of Kalpataru Projects International, joining in to discuss the numbers in details. Thanks a lot, Amit, for joining in. The first quarter, you did see profits decline by 19%. Revenue grew just about 8%, as against your own expectations for the full year, upwards of 20%. Now that we're in the middle of the second quarter, I wanted to know if you've seen any recovery in the pace of execution. If you could give us a sense of whether you will continue to maintain your 20% growth guidance for the full year.
So first of all, 100% we are confident that we will maintain our guidance of growth for the entire year. You made my job easier. Yes, the first quarter was exceptional with extreme heat waves and severe crisis of labor at most of our project sites. And that was because of a very long 5-phase election. And as you know, most of them are only starting to come back now. And already we can see the pace of activity picking up. So I'm not overtly worried about a little drop. That was because of less revenue than we had thought. And one of our sectors, which is water, which is primarily government, had a revenue shortfall, which was a one-time event. But I think we'll pick that up in Q3, Q4. So we're pretty confident at the end of the year, we should maintain the growth guidance of 20% for the full year.
Got it. All right. Hi, Amit. Good morning and good to see you in. This is Nigel on this side. So revenue growth, you're saying no worries on that front. What about margins? Earlier you had guided from 8 to around 8.5%. Do you think you should be working with that number for the year? And also, if you could give us, what is the order inflow target that you have for the current fiscal?
Yeah. So Nigel, we had always guided that we will do a PBT of between 4.5% to 5%. And if you look at a standalone basis, we are at 4.4% with our PBT for the first quarter. And as I mentioned, we had some of our divisions like water, which are heavily government dependent, couldn't do the revenue as they had anticipated earlier. And I think as in Q3, Q4 that picks up, we are very confident that our overall guidance for the full year of PBT on a standalone basis of 4.5% to 5% will be maintained at the end. So far as EBITDA is concerned, it's practical for us to, we've been always saying that you should track our PBT percentages, whilst EBITDA will be in the range of 8.5% to 9%. We look at our PBT guidance for the full year at 4.5%, 5%, and we are pretty sure we'll maintain that.
And you're going to give us the order inflow as well. I think your order book is at around 57,000 crores, I think. And there is an L1 position of around 50,000 crores. You could give us the updated numbers and what's the inflow target for the year?
So we have an L1, Nigel, this little correction of around 5,000 crores.
5,000 crores, apologies.
We are talking about an overall yearly guidance now that we have clarity post elections of close to 22 to 23,000 crores for the full year.
Right.
We've done well in the first quarter, and as of date, our inflow of orders is close to 7,000 crores already. And with some L1s, like you mentioned, of 5,000 crores. So we are confident we should be able to do 22 to 23,000 crores at the end of the fiscal.
Are you under-promising here? Because, you know, the first quarter itself, you've done 7,000 crores, and this was marked by a lot of disruptions, like you pointed out earlier as well. You are L1 in 5,000 crores. Together itself, that makes about 12,000 crores. Last year, you did close to 30,000 crores in terms of inflows. So 22 to 23,000 crores as against what you did last year and a couple of years ago as well. One would assume that you are under-promising out here. Could you give us a sense of how this 23,000 crore order wins would be spread across all your segments and what's realistic here?
So if you look at 23,000 crores construct, last year was an exceptional year because we had, you know, as you are aware, from 1st April last year, we transitioned to a merged entity and it's moving our profile to more EPC projects in nature as against in our yesteryears, wherein the first, 20% of the project duration generally is the engineering phase. And we still continue to grow with 20% year on year in terms of our top line growth. And I think what we are focused being Kalpataru is not just top line, but also bottom line, resource augmentation, management and delivery capability, and ensuring we always deliver our PBT percentages as promised. So I think 23,000 looks like a fair number, given that we have already a very strong order book in position. We are ensuring that, next year and this year, we continue to increase on our margin profile even further. And we believe that this should be a fair number for us to work with, because at the end, what is most important is not just winning orders, but delivering them also to all parameters.
Correct. All right. Very well put, Amit. What about the net working capital days? That's moved up, I think, by around 20 days or so, at around 120 days plus. Tell us, where does this number settle down at? And also the debt numbers, you're very comfortable with there?
So our net working capital, of course, for, after a long time is at a number of 122 days, as you mentioned. We will, at the end of the year, get our working capital days back to below 100, where we've always been. This first quarter, like we said, our revenue could have been more, given the fact that we had elections and there was a slowdown in general. But I think as our order execution picks up steam Q3, Q4, we should be able to come less than 100 days of net working capital at the end of the financial year. So far as debt is concerned, yes. Again, we had some of our inflows from clients which are primarily in government because of capital allocation being delayed. And we are already seeing that change in July and progressively in August and Q3, Q4. So I think that debt number, which went up this Q1, should come down to our regular levels, where our interest cost as a percentage of revenue should be at around 2% at the end of the year.
Right. That makes sense. Final question then. Promoters pared their stake by about 5% in the last month. What's the plan here? Are they looking to pare some more? Because as I see, 33% of the promoters' stake is pledged as well. So what's the plan on depledging that?
So I think if you look at our current YTD pledge numbers for promoters have already come down below 30%. And I think they are just short of 29%, which is one of the lowest that it has been for a very, very long period of time. There was also some of the debt that was repaid as a part of the overall pledge reduction. So going forward from what we are given to understand, I do not see any more pairing of debt happening, at least in the near pairing of percentage shareholding happening in the near term. And so far as pledge is concerned, as you can see from 31st March 24 levels, it has already come down below 30%. And I think that is the only trend that will continue going forward. I don't see, at least in the immediate term, any pledge percentages going up from where they stand currently today.
Hey, all right, Amit, thanks a lot for joining in. It was a bit of a soft quarter, but as you mentioned, a whole host of one-offs, elections, heat wave, and labor shortage as well, but sounding extremely confident about the remainder of this year. Could explain why the stock is only down 1.5% or thereabouts. Well, time to get you some ideas of profit in our special segment from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock that is tracking closely. Sachin?
The stock in focus is Apex Frozen Foods, which is one of the largest producers and exporters of frozen shrimp in the country, catering largely to the European as well as the US markets. The financial performance of the business has been quite disappointing of late due to intense competitive intensity in the international markets. Oversupply of frozen shrimp, especially from the Equator region, has had a negative impact on the realizations as well as the volumes of the company in FY24, and therefore the revenues in FY24 were down compared to last year. Also, the margins were under pressure due to similar reasons. However, things are shaping up for the business, primarily due to the announcement with respect to the budget which the company stands to benefit from. The government has in fact allocated 20,000 crores for the development of the overall marine as well as the aquaculture sector. And also there have been some certain exemptions in terms of the cost of raw materials such as shrimp feed and other raw materials, which should make the business more competitive from a cost standpoint. Therefore, overall cost competitiveness of the domestic shrimp producers would be enhanced with respect to the international players. And Apex Frozen Foods, being one of the largest players in the country, certainly stands to benefit from these developments. The business also enjoys very robust fundamentals, and therefore investors can look forward to acquiring the stock gradually from a long-term standpoint.
All right, take a short break. Come back on the other side. We'll get you more on the market, stock-specific action, get in a couple of managements as well. Stay tuned to Chartbusters.
Welcome back. Well, steel manufacturer Jai Balaji, they released a rather good set of numbers, one of the highest EBITDA margins we have ever seen, profitability as well up more than 20% on a year-on-year basis. Mr. Aditya Jajodia, who is the chairman of Jai Balaji Industries, joins us on the show to help us out with a quick analysis. Hi Aditya, good morning and always good to see you. Congratulations on a good set of numbers. I think the problem is the stock price has risen so much that the street wants even more. So explains why we're not getting a very big positive reaction on the stock price, because it's already up 7-8 times from the recent lows. Let's get to the numbers. Q1 growth is in mid-teens. You're guiding for 25 to 30%, but pricing is under pressure. So what is the volume growth you're looking at, and how confident are you of revenue growth of more than 25% for this year?
See, as far as our guidance for revenue is concerned, firstly, thank you for the very nice
Good to have you.
Yeah. It's nice to see you. So as far as the guidance for the revenue growth is there, we are absolutely sticking to it, because the pricing in the value-added products in which we are making, there has not been a substantial correction. Those prices are more or less holding up, and in fact, demand is very good. And the projects which we were to execute, they're all on time. So the volume growth is also going to happen. So the guidance as far as the revenue growth was concerned, we are sticking absolutely to that.
Right. And what about in volume, sir?
Pricing pressure has been more on the commodity items like HR and TMT bars, etc. So means that percentage of sales in our product portfolio is not very high as such.
Okay, Aditya, give us some numbers. You know, you highlight that ferroalloys as well as DI pipes, they are, you know, some part of that value-added products that you talk about the mix. Yeah. What are the numbers you're looking at? Last year you did around 74,000 tons of ferroalloys, and I think on DI pipes you did around 2.39 lakh tons. So for this year, what is the growth you're looking at on both those two segments?
See, in this ductile iron pipes, we are looking at a production of around 4 to 4.5 lakh tons annually this year, because the major capex which has been executed, one portion of that will be operational from the month of September. So we'll get 6 months of clear-cut run of the enhanced production. Even in ferroalloys, we are looking at a volume of around 1,50,000 to be achieved by the end of this year.
Okay, right, and you're saying production, it will be sales also will be more or less in line?
Yeah, absolutely. Sales will be in line because demand is robust.
So that's nearly doubling your volumes in ferroalloys over FY24 and almost doubling for the DI pipes as well. 4.5 lakh is what you're guiding for this year versus 2.39 lakh what you had done earlier. Let's talk about a couple of other parameters. Then you said value added. That's going to increase from what, 55% all the way up to 80%. Where does it stand now, and when does it go to that 80% mark? What does it do to your margins?
Currently, we are around 50-55%. And by the first quarter of next year, that is by the end of this year or the first quarter of next year, we'll be around 75-80%, 85% also.
All right. And what does that do to your margins? Because 17 to 18% is what you've guided for this year. And you had said that once all of this comes on board, it goes to 20%. So, I mean, is there a glide path to that 20%?
Yeah, it is the right path to 20%. So our guidance will be little conservative and muted. So I think our guidance will be in the region of 18 to 20%. So, so I think in this particular quarter itself, we have done 18.5%. And as the share of value reported goes up, this will be enhanced. But let us keep it conservative at 18 to 20%.
Okay, all right. And post this capacity coming on stream, you had told us that your revenue potential will be around 9.5 to 10,000 crores in FY27. Is that on track?
Absolutely on track.
Do you think you can do that 10,000 crores in FY27? You know, the reason I ask you this, Aditya, is because currently your market cap is 16,000 crores. You know, even if you do 10,000 crores and you do an EBITDA of close to 18%, means 1,800 crores. For a, for a steel company or with value-added focus, still you're not going to be very, very cheap, though there'll be big potential from here. So 10,000 crores, 1,800 crores, FY27. That's what you're giving us?
Absolutely. Means as far as the numbers are concerned, our guidance is for the percent. The amount you all can always, you're an analyst, I think you all can calculate better.
I think we calculated correct, right? You'll be in our camp.
Yeah.
Yeah, because normally on our show, we go for the numbers, and you're giving us those numbers and the street is listening in. So give us some few numbers. You had taken warrants and you've been gradually converting those warrants. Wow. It's been a great decision actually to go ahead because your shareholding in the company as well has moved up from around 50%. You all were in troubled times and the promoter entity has backed the entity. Now it's moved to around 65%. Once the entire conversion of shares takes place, where does the promoter holding go to? And for someone that has converted shares, got shares at much lower prices, how do you feel as an investor? The stock has already gone up 7 times. Do you keep the faith or do you think that at some point of time you'll say, might as well take some money off the table?
See, I will answer your question in 2 parts. Number one, the promoter stake will go up to 64% after all the conversion, which has already taken place. Number 2, as far as the faith is concerned, the question of faith arose when the company was in trouble. When the company is out of the woods and when the company is doing well, expansion is going on, and we are about to be debt free. So the question of faith does not arise now. Means the question of faith was 2 years back when all this exercise was done, and when the promoters decided to infuse the capital. So as far as the faith is concerned, it is our child, it is our baby. So our faith will be eternal, obviously.
And you supported the baby at that point of time, but now as an analyst, as a financial analyst, when you're making 8 times on the same share, as a financial analyst, what do you think? Do you think at some point of time, maybe if the price goes a little higher, you'll get tempted, let's take some money off the table, book some profits as well? Or do you say, no, I have shown the faith, this is my baby, I want to hold all 65% in the company?
Exactly. That is we are not financial investors in the company. This is our own company. So we are the promoter, strategic investor in the company. So our view will never be restricted to 7 times, 8 times, 5 times, 2 times, minus whatever.
We got that.
Very, very long term.
Yeah, just one question before we let you go. You might want to hold on to the stake that you own in the company. It may not necessarily amount to 65% if you are looking for some other investors as well. Would you mind looking at some fundraising in the very near future, say 12 to 18 months?
See, as of now, the capex plans which we had announced for 1,000 crores, out of that 600 crores is already complete. And only 400 crores is pending, which we are going to complete. Our guidance is for 12 months, but we are optimistic that in the next 9 months only it will be completed. So as of now, the company has no requirement for funds. So the funds will not be raised just because the markets are good or the markets are going to be bubbly. It is not going to be because of that. Fundraising immediately at this moment of time, since the company does not require the funds, we have no immediate plans to raise the funds.
Got it.
In the near future, अगर 1 साल बाद requirement हुआ, 2 साल requirement हुआ, तो फिर उसमें call लिया जाएगा. As per the situation.
At that point of time, we'll be waiting to interview you yet again and find out what is your vision for now. That baby you took care of, it's done very, very well. But the outlook from here on is going to be tracked because, as I mentioned earlier, it's not a small company any longer. The market capitalization is $2 billion. Appreciate you joining in, Aditya, and fielding all our questions. We look forward to having a chat with you at the end of the coming quarter as well. The stock price, well, in the last 1 month is up only around 5%. But if you look at it in the last 1 year, the stock has gone from around 150 rupees all the way to around 900 rupees. Though in the last 3 to 4 months, it's come off from around that 1200 rupee odd mark. Well, time to slip into a short break. Come back, continue our focus on markets and stock-specific action. Don't go anywhere. Welcome back. Well, the markets are bursting away as we speak. So it's a big up move is what we're seeing from the lows of the day. We're up 150 points. And what's doing well on the headline index is HDFC Life. That was down 2% at the start of trade. We explained this in the past week on Editors Roundtable as well, that valuations are supportive. The insurance part of the market was one of the big underperformers, and no shocker coming from the budget. So that's why the insurance stocks are running along. HDFC Bank, that's the heavier weight in there from the same group. That one is powering away, and ICICI Bank as well. And out of nowhere, the Nifty Bank is now up 275 points. So big up move is what we're seeing. But that's it from Mangalam and myself and the entire team that put this show together. You stay with us. Trading Hour comes up next.